Hi, and welcome to Swissquote's Daily Market Talk. It's Friday, December 12th. The S&P 500 tiptoed higher yesterday as investors continue to digest the Federal Reserve's 25 basis point cut earlier this week. Value stocks benefited from rotation out of technology, which faces bigger challenges than just borrowing costs, including circularity, high debt levels, regardless of how much debt costs and uncertain revenue outlooks for these companies. So in that context, Broadcom's strong results yesterday after the bell weren't enough to lift investor sentiment as concerns about margins and AI profitability kept investors cautious. So a big week ends with big questions, and we'll be talking about all that and more. But before we dive in, please keep in mind that opinions are my own and this is not financial advice. So the good news is that S&P 500 continued to push higher yesterday as the US 2-year yield wavered around the 3.5% mark following a rate cut from the Federal Reserve earlier this week that was perceived as being not that hawkish after all. The rate cut is especially boosting the non-technology pockets of the market right now. The S&P 500's equal-weighted index, for example, is catching up with the technology-heavy market cap-weighted version, meaning that the S&P 500 has probably further upside potential from this rotation from growth toward the value stocks. Now, normally the technology and growth heavy sectors tend to react more to the changes in the borrowing cost because the part of the future revenue that gets discounted to today is bigger than the value in names that simply rely on actual revenue. But you'd agree with me that the actual sky-high valuations in technology and AI stocks make them somehow less reactive to the Fed's rate cuts today. You might have heard that investors have bigger concerns for these tech companies than just the Fed's policy and the borrowing costs. As such, Nasdaq 100 failed to eke out gains yesterday after the Federal Reserve rate cut as a more than 10% slump in Oracle's share price dampened the mood among the technology investors and pulled the rest of the AI stocks down with it. Nvidia, for example, lost more than 1.5% yesterday on worries about the circularity of the AI deals and for being situated in the very middle of the biggest AI circle to date, the one surrounding OpenAI. Now, if it's any comfort to anyone, OpenAI announced a $1 billion deal with Disney yesterday. Disney will invest $1 billion in OpenAI in the context of this deal that will, in return, allow its Sora users to generate short videos from text using more than 200 Disney, Marvel, Pixar, and Star Wars characters. I understand if you are skeptical, but it's an interesting revenue channel for OpenAI, mind you, as content creators will be willing to spend more on Sora, which has been quite a flash in the pan since its launch, because they will be able to earn more money using the notoriety of these Marvel and Disney characters on YouTube, for example. So to me, this latest announcement comes as a good news for those who are actually wondering how these companies, how OpenAI will be turning its AI models and investments into actual revenues by avoiding advertisement. This is what OpenAI does today. The OpenAI Disney deal is that alternative to pushing tens of thousands of advertisement posts on your chatbots that would make them look as annoying as Facebook's feed today. It doesn't have the same upside potential, sure, as advertisement revenue because Facebook, for example, earned $51.24 billion last quarter, and approximately $50 billion of that total was from advertisement. But it does give you an idea on how OpenAI turns its models into cash. This company has deals with a wide range of industries. It's not only fun and done. They have a partnership with Microsoft. Everybody knows that. The Copilot uses OpenAI's intelligence, but they also have a partnership with Eli Lilly, for example, which is a drug maker company known for its obesity drugs for R&D and drug discovery using AI. They have a deal with Walmart to let users buy products through ChatGPT's conversational commerce interface and maybe share their revenue. They used to work with Shopify and Etsy, providing them shopping and chat commerce capabilities in exchange for fees. They have a deal with Databricks to embed advanced OpenAI models into Databricks platform for enterprise customers. I mean, they have few deals that are running and bringing money. The company must sure announce plenty more of these deals to live up to its hefty valuation and sky-high valuations of its partners. But I find the negative press around OpenAI just too negative for a company that just 3 years ago made a big change in the way we interact with machines. Now, unfortunately, my blah blah doesn't answer the question of, is this a bubble? I don't know. Nobody knows. The only thing we know is internet outlived a lot of companies back in the dot-com crisis. AI will probably outlive a lot of companies that are being boosted today. But we are pretty much sure that the AI capabilities have ways to expand toward different industries and different clients, ranging from Microsoft, Italy, Walmart, banks, Disney, and you name it. And potentially every blue-collar job lost would also contribute to the AI's success. So, with this being said, Broadcom was the latest AI-related company announcing great results yesterday, unsurprisingly. The revenue there jumped 28% to 18 billion US dollars and earnings surpassed expectations as well on the back of surging AI chip demand, of course. The company said that they have 73 billion US dollar worth of AI related orders already booked. They issued an upbeat first quarter outlook of 19 billion US dollar in revenue and raised their dividend by 10%. Not bad at all. The problem is expectations were just too high, and after a quick upside attempt after the release of the results, the stock price slipped more than 4% in the after hours trading on rising concerns about margins and investor expectations around AI profitability, showing once again that great results no longer lead to great price rallies in AI stocks. So we're back to square one. Oracle and Broadcom earnings together reminded that AI demand remains strong, but leverage investments and uncertainty around revenue channels prevent investors from buying more of these AI-related stocks at the current valuations. Fair enough. Investors prefer buying gold, silver, and copper these days. Gold prices are actually back to a solid uptrend following the October downside correction and are today supported by lower US yields and a softer US dollar. Silver and copper, on the other hand, continue to benefit from the same soft dollar and soft US yields narrative. Plus, they are in a short supply market, adding to the strength of appetite for these metals. Oil bulls, on the other hand, are impossible to cheer up. Literally impossible to cheer up. The geopolitical tensions of earlier this week also failed to reverse losses in WTI, and the WTI is testing the $58 per barrel support to the downside again this morning. Blame it on ample supply from US, from OPEC, and from non-OPEC oil pumpers, while the US dollar index tumbled below its 100-day moving average with room for further losses, which should normally support oil, but alas, it does not. So this week is ending on a dovish note for the Fed, positive note for treasuries, metals, and value stocks, and on a negative note for the US dollar, oil, and the technology stocks. Next week, the US CPI data release, the first one since the US government shutdown, will either confirm the post-Fed trend or challenge it. The last headline print was pointing at a 3% inflation in the US, above the Fed's 2% official inflation target. The sufficiently soft CPI read next week will likely reinforce the post-Fed price action into the year end, so we will then see Santa offer some fresh all-time high levels to some stock indices, especially to the smaller and the non-technology heavy ones, while a stronger than expected CPI read from the US next week could tame appetite and back the view that the Federal Reserve cannot just cut the interest rates next year as much as it wants if inflation keeps pressuring. So we will see that next week, but this is all for this week. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you, so do not hesitate to leave your comments, your reactions, and your questions below as you do usually. Follow us on Instagram, on X, on LinkedIn, also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button if you like these videos to let us know that you enjoy them. So I will meet you again next week, and until then, good day trading and have a lovely weekend.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.